All right. Welcome everybody to Midas Investing Live. Hope you all having a good Monday afternoon. Happy Martin Luther King Jr. Day. Here, one second. My stream dashboard's not giving me an image. My streaming software appears to be fine, but the YouTube part of it's kind of being a little weird. Give me 1 second. Doesn't appear anybody's here necessarily yet. Okay, there we go. All right, yeah, I think it was just not loading correctly there for a second, but it appears to be loaded. Anyway, happy MLK Day, as I was just saying to anybody out there. Hope you guys are having a good day. Thought I would do a stream today. Obviously didn't do one on Friday, Saturday, or Sunday, as I've kind of been doing some on those days. I figured I'd kind of change the day up a little bit and do it on Monday since I had no classes today. I'm assuming some of you guys had today off of work. Maybe some of you are at work regardless. Maybe some of you are busy with your families or something like that. But I thought I'd go through some stuff today, not too much. Right off the bat, I did want to say, if you're watching either live on the replay, please give the stream a like. It'd be really appreciated if you could give us a like, help attract more viewers to the stream. Also subscribe to the channel if you haven't already. Make sure you hit that notification bell as well so that you can get notified whenever I do release new valuation videos or streams such as this. And speaking of valuation videos, I did also put a new video out this week on Silvercorp Metals, SVM. So go check that out. I definitely think the work I did on that one's pretty good, and I'm very excited about the opportunity there. I believe I had already commented on it last week that I had started a position there, as well as with New Gold. Obviously, I only put a video out on Silvercorp, and maybe I'll put a video on New Gold, but I don't necessarily think I'm going to. But I also had started a position last week also with HSII, Heidrick and Struggles, which I do believe I'm going to be putting a video on that one as well. So you can keep your eyes out for that one maybe within the next week or so. I've already got the model fully built out, or got a thumbnail made up for it, so I really just need to record a video. And I think I've mostly kind of got all of my thoughts organized for that, so I could theoretically record it here very shortly. So maybe I'll have that one out within a week. It's kind of what I'm hoping for. Because, well, I did realize before putting that Silvercorp video out that it had been basically a month since my last video. I've been streaming obviously pretty much every week or so, but definitely was like, oh man, I got to get some videos out there. And obviously, for those of you that have been here for the last several weeks in the live streams, you've seen that we've been on a little bit of a process, you know, to try to narrow down a lot of opportunities and find some potential value gems. What with all the pricing analyses that we're doing. And I was kind of promising last week that I would probably be continuing to do a lot of that stuff, and I still am going to be continuing to do a lot of that stuff. But essentially, I didn't really do too much more work on the pricing analyses this week. I instead kind of opted for working on those models for Silvercorp as well as Heidrick and Struggles, because I really wanted to get that video out. And then, like I said, I've got potentially another video kind of working on as well, because while I say I'm thinking about the Heidrick and Struggles one, but I do also have the Premier Health one as a potential as well. I did make a model for that one and put it on the dashboard a couple weeks back, which obviously I kind of opted for these other companies, and it's partially because I like those opportunities a little bit better. But we'll have to see. Maybe I'll make a video on that one as well, because I did make a model on it. I am trying to kind of get the content rolling since I took several weeks off in that regards. So anyway, taking a look at the portfolio here, not too much necessarily comment on in terms of actions this week. For the most part, was just nibbling at Heidrick and Struggles, as well as a little bit of Silvercorp. Definitely planning to be buying into Heidrick and Struggles. There's a very interesting opportunity there, which, like I said, whenever I get that video out, you guys can take a look at some of the stuff there. And then I'll be continuing to nibble at Silvercorp. But that one, it definitely has a lower minimum level to our allocation size. So how much we actually end up nibbling on a regular basis will probably be a little bit more minimal, but that works considering it's a relatively small company. Hey Scott, how's it going? So anyway, coming down here, taking a look at our returns, definitely in terms of the holdings in our portfolio, everything's kind of doing pretty good for the most part. Everything's in positive territory except for Interfor and InMode, and then our put options, with obviously major gainers continuing to be kind of in the same area as they are. Our year-to-date returns, underperforming the index. Definitely not what we want to see already. We're already, let's see, we're negative 1.7% for the year so far, while the index is about positive 0.3. So we're about 2% under the index already, which is not great. But the small cap index is at negative 3.7. So they're about 2% lower than us. So we're kind of, you know, halfway in between the two of them, I guess. But we've got to catch up with the S&P, definitely. That's for sure. Scott, Skyworks waiting for more nibbles because you got others now. Yeah, definitely. I mean, like I said, I'm still eyeing Skyworks, but I really want to, as we were kind of discussing, I want to see it under 100, ideally, to probably add a little bit more to that. But yeah, I kind of agree for under 100 would be a pretty good spot to add a little bit more on that one. Simon DeHares, welcome. I don't think I've seen you in the chat before. No BABA in the portfolio. Yeah, no BABA in the portfolio. I did actually have BABA at one point some time ago. I was trying to catch that falling knife way back during its dropping season, and I did get a little bit burned on that one, eventually hopping out. Of course, based off of your question, I assume that means you think that BABA is a great value, so you would probably assume that I made a mistake by choosing to abandon the investment. But I will say that in general, I have not the most optimistic takes when it comes to the Chinese demography and how that's going to affect the potential for the economic growth in China going forward. So that's one of the reasons that I was a little bit shy off of BABA. I feel like I made some mistakes early on in the valuation. I also hopped into the valuation much too early on, and I'm really not trying to focus on investments in certain countries where I believe they have major demographic concerns, as well as I'm not very fond of their governing structure either, in the way that they're not very they're not very friendly towards capital owners in general. There are certain industries that I am willing to operate a little bit more towards in China versus others, especially like Chinese companies that offer services outside to the rest of the world outside of China. I'm definitely more interested in those types of companies, as well as certain base industries as well. But BABA, which is definitely very, very still Asian centric. I know they worked to try to break out of their Asian revenues a little bit. They definitely tried to expand a little bit outside that, but they've definitely always had a little bit of difficulty with that. And most people's bullish takes on BABA still just kind of surrounds the idea of continuing urbanization in the Chinese economy, which I definitely have my concerns about. So that's my thoughts on BABA. Yeah, I'm definitely not very optimistic on them. That's not to say that where they're currently at, that they're not perhaps good value, because they have come down so much. So it's possible that like where they're currently at, they could maybe be about fair value-ish. I don't really have a take on like the actual valuation per se. I just am not very fond of the story, so to speak, around that one, and I don't really want to be involved in it. But yeah, so anyway, coming over to the dashboard, our valuation dashboard, where you can see all the companies we do actually have valuations for. As I had just been kind of talking about, we obviously put the Silvercorp video out this week, so we have that one added to the dashboard. And then I do also have HSII, Heidrick & Struggles, added to the dashboard as well. And both of them are two of the best companies here on the dashboard. So yeah, that's could easily explain why I'm buying into those ones. Obviously still nibbling at InMode as well here and there on down days a little bit here as well. But then here's the one I was just talking about, Premier Inc. For healthcare, which I could theoretically maybe make a video on at some point in the future as well. I'm just a little bit less excited about this one compared to Silvercorp and Heidrick & Struggles. Part of my hesitation around this one comes from, I guess, not really seeing where this company has the potential for as strong of a competitive advantage in their industry relative to some of the other ones. And so it makes it harder for me to feel really confident in the valuation, but the valuation nonetheless still looks really good. So if it does get below that 25th percentile in terms of our distribution that we created, might have to add that one to the portfolio at some point too. You know, it's like if it looks good enough, it could end up that way. Also, I took some readjustments to a few of the companies in the portfolio here. I went and kind of readjusted the valuation a little bit, partially because these companies were overvalued here towards the bottom of the companies that I own, that being Meta Platforms and Fidelity National Financial. one more overvalued than the other. So I made some adjustments to the valuation on each of them, finding that Meta really, it didn't really change that much, I believe, when I was looking at it. But I believe Fidelity ended up actually getting a little bit of a boost. But then I went back and kind of adjusted a few other ones, trying to kind of take a look if I needed some trimming on some other ones as well. I knew I had been overly pessimistic on Advanced Auto Parts and some of the assumptions I'd had for the last several months. So I went back through and was looking to see if I was maybe being too pessimistic there, and I ended up giving them a little bit of a boost. I ended up doing the same thing to Interfor, and then I also let's see, I think that's the only ones I ended up giving any more boost to. But the point is I was kind of looking for things to potentially trim in the portfolio, and then kind of ended up opting for not really doing too much more trimming any further. I still might maybe trim a share or two of Fidelity, possibly, just because that one's a little bit overvalued, and is at the upper end of its allocation size as well. So we could end up trimming a little bit of that one, but not necessarily in the biggest of rushes on that front either. Coming over to the potential page, nothing really changed here, because as I had said, I'd been was focused more on building those models for the companies that I was working on videos for. So I didn't really go doing any more basic valuations this week, particularly. I'm really going to try to do more of that this week. But we moved companies off of this page onto the other page. Obviously, that was kind of the one thing that did happen sort of this week in regards to this page. I did also end up adjusting, because I did actually build basically a full model for New Gold. So I haven't moved it over to the other page, but that's partially because I'm trying to decide exactly what I want to do with this one. The value that I saw in it definitely came down after I built a full model for it, because I think I had it more like 25 to 30% of upside or something last week, and now I have it more like 10 to 11% of upside. So I definitely brought this one down a little bit this week after building a more full model for it. And I haven't like finalized all of it, and I haven't moved over to the other page, but it's possible that this one I might end up letting go a little bit quicker than the other one. I ended up jumping into Silvercorp and New Gold. It's possible maybe I'll just end up keeping essentially one of them over the other. Scott Schwab, trimming if 80s come, but was thinking maybe even 75 was a good trim spot. Yeah, it could be. Let's see, what was my, I have 69 or so for the value. And then I have the 25th percentile at 54 or so. So that's like about a 15% spread between the 25th and the value, which means we could maybe push up to the 75th using approximately the same logic. So yeah, 80s would definitely be kind of pushing up towards the 75th percentile. Was basically kind of where I'm going with that. Hard to say for sure, but you have to look on the other page. No, I didn't get into pink. I just added them to the dashboard. If it's not purple here on this column, then they're not in my portfolio. That's usually how I signify that. So yeah, I added Premier to the dashboard because they kind of had a lot of information in their filing, so they made it really easy to build a pretty thorough model for them. But I didn't jump into them because I don't know, I just don't quite feel as confident about that one. It makes it hard for me to feel super confident exactly in like the competitive advantage within their industry, because if you remember, that was like one of the healthcare supplier ones that also had some like technology stuff along with its supplies, and they had pretty good margins compared to some other suppliers. And so it was definitely one of those things that I was like, it's hard to be sure exactly how defendable those margins were. So the valuation I just felt less confident on. I might end up going for them if they get low enough though. That's the thing. It's like, just not yet. You know, maybe if they get below that 25th percentile, maybe they'll start to be much more of an attractive option. Anyway, so one other thing for people who are watching live on the replay, I did kind of want to bring this up. I haven't talked about it too much for a long while, but that's partially due to the reasons we'll discuss here in a minute. So this dashboard that's right in front of me, I obviously originally created this with the hopes of essentially trying to provide it to some of my viewers, especially people who are paying. It's definitely wasn't planning to do it for free, but I was planning to offer this dashboard, essentially give a version of this file to different people for a relatively small monthly fee. And then you guys could have access to essentially all the valuations that I've done right here. And I had built separate back pages here where you could then also pull up 10 years worth of the financials as I've organized them for my valuations, as well as the summaries of the DCFs that I've built, including the distributions and the internal assumptions for the revenue growth, the margins, the capital expenditures, and all the other things like that go into the valuation itself. So I basically tried to build essentially a template file where you guys could look up the summation of all of the research that I do on the channel, so to speak. And like I said, for essentially like, I don't know, $5 a month was kind of my targeting idea. I wasn't going to necessarily be able to offer it to a million people, but that was something that I wanted to do originally. But I definitely ran into a bunch of roadblocks, partially just with like the technology that I'm using here. This is Google Sheets and it has its limitations. And so I kind of ran into a bunch of problems with it that was kind of preventing me from getting to that point. But I think that I've worked out a lot of those issues. So I kind of wanted to kind of like offer that. People want to mention it in the comments if they're interested or something like that. That would be really, really helpful. Probably I don't know, maybe put together like I already have a PayPal link that's available, so you guys could theoretically pay me through PayPal, but I could also set up like a Patreon or something like that. I have never gone and made a Patreon before, but I could go and do that and set up like a $5 a month tier thing for that and make it so that basically people would have access to their own version of this dashboard file. I'm also planning to kind of add some other details to it as well. I want to make like another page to show like the last trailing 3 months or 6 months of the S&P 500 small cap indices, as well as maybe sector indices. I might also have like a chart for the 10-year treasury, the dollar index, and the oil stuff. So I have like these kind of basic market details up here, but I kind of wanted to make maybe a separate page to show those on a chart a little bit as well. And then there are some other features I kind of want to add along the way. But the point is it was mostly the ability to share these files and make them update automatically was the roadblocks I was kind of running into. But I've mostly kind of worked out a lot of those kinks. So I'm willing to try to experiment with some customers if people wanted to essentially become beta customers for this project. Scott here in the chat is already my beta tester for this. That's basically what he's referring to when he says he'll actually just go look up the 75th percentile for Schwab, and that's because he has the ability to go and do that. So point is I could offer this to a decent handful more people as well for free, like I said. So anyway, today, what we were gonna maybe do today, I don't know, what I kind of had in mind was maybe I could kind of go through and show you guys how I do kind of my valuation process on a somewhat basic level. If you guys wanted to see one, I haven't really done an actual valuation live for a long time. I used to do most of my valuations live, but I do have this side list of other companies that I've been looking at. So unless you guys have some specific tickers you wanted to look at, I could actually just do a basic DCF of one of these right here. You guys could name one if you wanted to. Any of these companies that sounds appealing, we could pick one and I could do a basic valuation for it. I kind of already had been going through a lot of them, trying to identify some other opportunities before the stream today. I did find a couple other natural resource companies that look kind of interesting here. A few REITs that look actually kind of interesting amongst this list that I want to take a look at. And then people were talking a lot about Build-A-Bear Workshop, but I actually did a basic valuation on Build-A-Bear already, which I mean, I could show you guys that one, but spoiler alert, it's not very pretty. They just have way too much debt and the margins it's kind of hard to tell exactly how sustainable the margins are. But yeah, I don't know if you guys have seen any companies on this list that sound appealing, we could maybe just go through and do a basic DCF of it. I was kind of ignoring some of the ones near the top of the list. There's a whole lot of home builders in the list. Tapestry, Wells Fargo. I don't really want to do a financial. Urban Outfitters, Master Brands, Winnebago, Caesars, Benchmarks. FedEx. Kroger. Kroger's one of the ones that stood out as being 2 standard deviations or more of underpriced relative to its peers in the pricing, but then it has really, really tiny margins and a lot of debt, so it may not look that pretty in terms of that. SpartanNash is a small was it like a retailer and convenience store operator or something like that? I think it had like a small grocery stores or something like that, but I believe they had tiny margins as well. So Encora, that's AmerisourceBergen. They changed their name. I remember I didn't recognize the name at first, and I went looking at it. I was like, "Oh, this is AmerisourceBergen." That one caught me by surprise a little bit. FedEx, P-Lab, TH, IP. Yeah, IP I definitely want to look at some point amongst the grouping. FedEx maybe? Do you want to take a look at FedEx? Maybe PLab? Let's take a quick look at some of the metrics. I kind of like want to choose one ideally with some positive growth rates and that has been is trading a little bit below its more recent PEs. You know, I don't want something that's trending upward in its valuation. I want something that's kind of trending a bit downward ideally. But beyond that, we'll kind of just go with whatever. This one's at least kind of around its average. So yeah, I could go for FedEx. I could go for FedEx. PLab. I already looked at CMI, remember? I was telling you, I already looked at CMI. They weren't looking too attractive. PLab's looking cheap on a relative historical basis. It's got positive growth rates. So FedEx or PLab? PLab's got stronger margins. That might be a bit more fun. Why is there no free cash flow projections here? That's kind of interesting. What's up with that? Yeah, maybe we'll take a look at this one. IP chart looks good, you think? Maybe. I have to double check on IP because I think that one might have some weird details to it that makes it difficult. I'm trying to remember if this one has like some weird share structures to it or something. I feel like I remember there being some kind of weird share structure, family, like there was like previous family ownership or something, but I think they have like a, I don't know. I kind of want to maybe look at this one a little bit, yeah, maybe privately on my own. I might require a little bit more careful looking than just kind of doing it. Let's do Photronics. Let's go for Photronics. All right, so we get the come over here. Financials kind of lined up a little bit. Make a folder. Yeah, I was originally planning to just kind of be like, you know what, I'll do one for Build-A-Bear, but I actually had forgotten that I had already done a Build-A-Bear one. So because I was thinking about that since everybody was kind of talking about it in the Discord. I was like, oh, we'll do that one. But then I was like, well, I guess we can decide together. Because otherwise I was planning to kind of have all this stuff sort of set up already. So I didn't have to go through some of these details. But yeah, so I got 4 different little file thingies that I use, which is a little bit complicated. I have this one page where I have I call it my details file, but basically it has the comparable groupings are on this file, but it's also where I build a model if I'm going to build one for them. But it's also where I have my weighted average cost of capital and my terminal multiple kind of calculations where I do stuff here. So it's really just kind of like a little bit of everything. Like this file is kind of just for like doing the extra stuff, which is why I kind of call it the details. Then I have a financials file, which is just for kind of reorganizing the financial statements essentially into their correct process. And then I have the pricing file, which basically just analyzes the stock. It basically just does all the moving averages, the RSIs, and you know, all that stuff. And it's also where I put all the inputs for like insiders and stuff like that, if it's gonna have all of that stuff as well. And then all of these pages basically connect to each other on a back page, and then that basically just sends all the information back and forth between that. So it's a little bit of a kind of a complicated setup, but once you kind of like know how it's set up, you can kind of just put it together relatively simply. And then we have the DCF template, which is this last page over here, which is where we do, you know, all of the magic of actually making projections for the future, which this page also connects to basically everything else. So we have four files actually that all connect to each other. You have to give them all permissions to communicate with each other, which takes a minute. Oh, did I put the wrong one here? I did. And the reason why I do it this way is because then it sends basically all of the necessary information to this last file right here, the valuation one, and then I can send information from this one to the dashboard or to the portfolio page, however it's needed. And so it all connects together here, you know, in one place, basically by doing it that way. Basically just in different chunks. And you want the files to kind of be separated by different chunks because honestly, it's a lot of data processing. There's a lot of things going on. And so it makes it a little bit easier on the file if you're kind of doing it in separate chunks. All right, so then I have this other spreadsheet over here, which is, well, I have a couple of these spreadsheets, these two data tools that I made a while ago, which both of these come from Aswath the Moderon's data. Like this file right here is basically a compiler of data from Aswath the Moderon. I basically just copy paste a whole bunch of data from Aswath's data sets all into one little thing right here. And then I can look up all that data by industry by typing in all the numbers into one little space as it's all set up. And that way I can kind of look up all the data sets as I want. So what we need to do is we need to figure out exactly which data industry grouping that Photronic is specifically a part of so that we can then look up the industry grouping for that, which I'm going to assume it's part of the semiconductor group or maybe semiconductor equipment group or something like that, right? Let's see probably where it's grouped, but you always want to kind of double check. It could be computer parts, or some companies get put into weird groupings. Semi equipment, yeah, so it's put in the semi equipment grouping. So come over here, find out which number is the semi equipment industry grouping 79, and then come over here, type in 79 in there, and it pulls up all the semiconductor equipment stuff. So my adjusted unlevered beta for semiconductor equipment is 1.52. Come over here, type 1.52 into there. Then that's kind of like the start of doing that. I don't really know all of the countries of origin for Photronic's operations, so we're just going to make an estimate of 6.5 for their company ERP. It might be 6.5, 7.5. I don't really know how much of their operations they have internationally. That part I'd have to look into their files more detailed to figure out. And doing a basic DCF, I kind of just put some guesses in for that type of stuff. So now we come over back to Ticker and actually get the financial statements and copy paste them in, and we can actually start processing the data. So there's let's see, income statement, cash flow statement. Down here, just a few layers below, paste that in, go over balance sheets. All right, and then I made some changes recently because I used to have to basically then realign a whole bunch of these things automatically, but now I've changed these this spreadsheet around so that it actually automatically fills in most of these cells. There's really only a few lines here that I actually have to manually put in now, which is basically the purple ones. Wherever you see like a purple line right here, that's something I have to manually adjust, which really doesn't take too long compared to how long it used to take. Like I used to kind of have to do all this manually, which would take quite a long time, but now I just have to go through manually do a few specific things, which usually just takes like a minute or two. Like the R&D costs, I have to kind of manually make sure that gets put in here. The reason why I have to do it that way is because sometimes there's a few different items counted as like one specific category. And so you kind of need to like manually go in to make sure that like the items are being counted in the appropriate spots. Let's see, then there's depreciation costs, which oftentimes there's none of, like in this particular case, there's none. So that's all on that page. Then cash flow, let's see, there's depreciation on this one. And then come down to the property, plant, and equipment and other reinvestment items. I have to do that one manually as well, because that involves kind of adding a few different items together, which can be a little bit weird depending on the company. So that's why we have to do it manually, which still, like I said, just takes a quick moment, generally speaking. Okay, so those, boom. And then the debt financing as well, that has to be done manually. All right, now then the balance sheet, there's only a couple items that have to be done, which is the short-term and long-term debt. And then after that, we're done. We can go on to the actual DCF. So yeah, it doesn't take too long, just a couple minutes to kind of throw the financials together, which is good, because honestly, the analysis part of the DCF is the part you really want to spend much more time on. It'd be nice if I could get this 100% automated, but this doing all the financials and building a DCF like this, a basic DCF, used to take like an hour and a half to 2 hours. And so now I've got it to the point where I can do the financials in like 5 minutes, and then maybe like it takes, I don't know, 10 to 15 minutes of then doing that analysis. So I can now do a basic DCF in like 20 minutes when it used to take closer to 2 hours. All right, so now we have all the financials for 10 years put together, just like that. Took, I don't know, like I said, 5 minutes or something like that to do. Not too bad. We do have the pricing sheet over here, as I was talking about. So I could come over here. I could show you. We do have like the moving averages put together, the relative volume. I haven't put together the short interest thing, so this is technically just a blank thing that was from one of the other companies. I'd have to fill it in, but we do have the RSIs here as well. All that stuff kind of happens automatically. But then come over to the valuation one. Now that we're finally here, and now we can start actually putting together the assumptions of the valuation itself. Now we do have to put together a discount rate still. I usually make kind of some assumptions about the interest rate without going and looking through the 10K to find out what their actual listed cost is. I just assume the last 5 years, whatever their average interest rate was for the last 5 years, that's probably close to whatever their listed interest rate is. And then use the listed interest rate plus a weighted debt level plus their interest costs and their tax rate to then figure out what their current cost of debt is, which is likely either a little bit higher or lower than the listed interest rate. And that's the thing we want to use for their cost of debt. So it looks like it's about 2% for them. And it looks like they have a debt to equity ratio of about 1%. So they basically have no debt in the first place. So it doesn't even really matter too much. But either way, we'll come over here. Let's say about 2% for their interest rate, 1% for their debt to equity. Come over to their margins thing. It looks like we're going to have on average about 25% for their tax rate for the 5-year or the 10-year forward period. So we use 25% for their tax rate. We already have their unlevered beta, and we, like I said, took kind of a guess about their equity risk premium. So that part could be slightly wrong, but now we know their cost of capital should be about 11.7%. So 11.7%. Okay, cool. That's nice to know. Now we want to kind of think about what is their terminal multiple going to look like. Now, I like to often use a comp group for thinking about terminal multiples, but if we're doing a basic DCF, I don't really have time to necessarily do that. So I'll probably just rely on their longer term averages, which for here, for an EV to EBIT multiple and a PE ratio, I like to use both of them. We get 8.63 and 16.83. So kind of remember that. Come over here, 8.63 and 16.83 was it? Okay, I put those in here. Now this thing adjusts those numbers. I take the average of them and then I adjust it for the interest rates over the last 5 to 10 years. The reason why I do that is because these multiples were over a 10-year period where there was different interest rates than we have now. And PE ratios and interest rates are sensitive to each other. So we adjust that, and the average of 12.73 gets adjusted down to about 11.3 for that. So we're saying 11.3 would probably be a pretty reasonable mature company terminal multiple for Photronic. Like I said, it could be a little bit different if we included some comparables. That's what this section down here is for, which I'm not going to do that right now because that takes a little bit more time. But whatever, we'll go with that. So come over to our discount rate page. We like I said, we know we want 11.7% for our weighted average cost of capital, and we know we want kind of a mid 11s terminal multiple. I can come over here to where I kind of make adjustments for that. It currently has it about 13 and change, so we have to adjust it downward a little bit. I like to have the discount rate at the start be in line with the weighted average cost of capital that I calculated. And then I have it move towards a discount rate and a growth rate that makes the terminal multiple that we're trying to get towards. So that's kind of like how I move these things essentially towards the rate I'm targeting over time. So let's say we want 11.7 over here. I'll put 11, 12, and 13 right here. I'll make sure that it's an even distribution for the probabilities. And that means that we'll get an average of a 12 right here, which is, you know, higher than the 11.7 I got, but whatever, we're trying to be a little bit conservative. Now that's a pretty high cost of capital. So we'll probably move it downward over times and then adjust the discount rates based off of that. Because I assume maybe they'll probably actually take on some debt over the course of years, right? So maybe they would be lowering their cost of capital by taking on the debt at a relatively low level, and that could improve their overall standing. So let's see, this kind of will move towards the appropriate discount rate over time, and then we'll adjust the, like I said, the growth rates to kind of get to the terminal multiple that we're targeting, which I'll kind of assume maybe a little bit of higher growth for those levels in there. Mr. Beast, what's up? Scott, I missed the last message you said there, but it looks like there was a, I don't know, a typo there. You only have spreadsheet? I wasn't even sure what you said there. Anyway, coming over here, let's see, take a look. Let's see, it's giving us 13 for our multiple, so we're still a little bit up there. Maybe need to bring it down. Mr. Beast, how am I? I'm doing pretty good. Just doing a quick evaluation on Photronics live for y'all. Thought I'd kind of show the process a little bit. It looks like we're not getting good numbers down here. I think we may make some other assumptions changes before that. A second here. Let me double check something. But how have you been, man? That's the real question. Yeah, so we got to lower these growth rates to get us closer to that terminal multiple that we're looking for. Have I seen Medical Properties? Yes, I have seen Medical Properties. In fact, I relatively briefly was a shareholder of them before I decided that I thought they had a little bit too much risks associated with them. How have they been lately? I haven't paid attention to them since I got rid of them. Yeah, see, they're way lower now. I'm glad I got out of them. I was holding them back kind of during this time frame right here. So yeah, I would be down bad if I was still in them right now. But who knows? Maybe they're closer to where they're valued. You know, maybe that's closer to where they deserve to be. But yeah, I know there was a lot of concern surrounding their debt levels as well as some of their customers, in terms of the fact that some of their customers were needing financing from them in order to pay their debts, which is not exactly what you want to see. So definitely not good, not good. Oh, I know. That's why it's giving me the weird numbers down there. I was like, why is it giving us weird valuations here? That's right, I forgot. Because if I don't type a last dated number in here, it kind of does weird things with the calculations. Hard to explain why it does that. But if I don't have a date right there, it basically makes these values make no sense whatsoever. So like, watch, it'll jump to like a much more reasonable number. Boom, suddenly an actual positive number. Not a good number, but it's actually getting us a number now somewhere, which we still have a lot of things to adjust. I haven't adjusted the margins on here yet at all, or the growth rates or anything like that. We're just doing the growth rates, doing the terminal multiple and the discount rates first, because I like to kind of do those parts first, since there's a lot of things that kind of have to be taken into account with them. Okay, we'll leave that there actually for now. Now the growth rates, we'll come back over to ticker. This is, I think, like I said, with these DCFs, I very often like to just kind of rely on the analyst estimates for the next couple of years. I think, you know, they, at least especially for the revenue, they probably have at least a general idea of where things are going to go. I say that at least generally when there's at least more than one estimate here. The fact there's only one for each of them is definitely not super great. But whatever, that's as good as we're going to get. So 900 and change, about $1 billion for 2025. And they're seeing like 200 change, close to 300 for the EBIT thereafter. So I mean, yeah, we gotta push up some growth rates a little bit. How much did they grow over the last decade? So I mean, they doubled the revenue over the last decade, pretty much. Not amazing, but definitely something. That's definitely, you know, substantial. So the idea that they would, what we got kind of going on right here is another 30 to 35% or something like that, right? We can easily push up more, I would say. We're definitely not pushing the limits at all here. So 900 change, we still got to push it up a little bit more. And just doing random things with the growth rates until it makes something nice. It's like, unless I build a model for the company, it's like any growth rate doesn't, you know, it's just a guess at the end of the day until you've looked at something like that. Have I valued Tilray, or will I value Tilray someday? I have never really looked at Tilray too specifically. I've kind of avoided the marijuana space entirely, except for looking at innovative properties back in the day. I did have a pretty nice investment in that way back when. I've never really looked at the actual producers themselves too much, but maybe at some point. I've definitely been hearing some rumblings surrounding the legal stuff once again. You know, it's hard to tell how serious to take any of that since, you know, we've been kind of toyed along on that one for so long. But yeah, I don't know, maybe take a look at it. I haven't looked at them in a long time, so I have no idea what their situation looks like financially, prior to merger with Alphria. Interesting. I love how it has like multiple tracks up here. Like, what's the valuation looking like these days? Terribly unprofitable still on profitability basis. EV to revenues is pretty low, down to 2. So I mean, it's at least a normal EV to revenues, but they're not profitable still, it looks like. So that's part of the issue, I guess. So yeah, still a total basket case is essentially the true answer. Insiders buying, interesting. So anyway, let's keep going with this. I got some growth rates in there. I don't know. It's not, like I said, it's a little bit less than the previous decade of growth. Let's kind of assume that for the time being. Let's take a look at what their margins have looked like for the last decade. We saw on average 14.5% margins for the last decade. If we include the trailing 12 months, it's about 15 to 16. We can see the margins spiked up here in the last couple of years. So the question is really, you know, how sustainable that's going to be. If we're looking at like the 5 to 6 year rolling average, it's more like 19.7 for the last 5 6, but then the 5 6 before that, it's like 11. So anywhere between 11 and 19%. It's pretty wide kind of ranging for the operating margins. But again, most of it leaning towards the more recent. If we're looking at the averages prior to 2020, it's more like just an 11%. So yeah, it's a little bit tricky to maybe nail in on what the operating margin should actually be for that, which is definitely going to be a trickier part of the calculation. I don't know. We'll just assume the longer term average, 16%. Let's come down to the cash flows. On a yearly basis, the adjusted reinvestment as a percentage of sales has been about 2.6%. If we take an aggregated level, taking out acquisitions, so just looking at organic reinvestments, it ends up being 2.2%. So 2.2%, 2.6%, you know, 2 to 3% or something like that is enough for that. And we're looking at less sales growth this next decade than the previous one, so we could probably go less reinvestment than the previous decade too. So maybe even just down to 2% if we're talking about purely organic levels, maybe. So okay, let's go with that. We got 10, 15, 20 for our terminal operating margins, which is already pretty good and in line with what we would look for. But let's think about like the first 5 years. We probably want to adjust this a little bit. Looks like we have some different stuff kind of already in here. 19% for the first 5 years on average across those cases. Some of them need to be adjusted down, and then kind of similarly, yeah. So let's make some new numbers up here. These ones are just kind of the default numbers I had in place. So the operating margins for the next couple years are, oh, whoops, I went to Tilray, forgot. Let's go back. Let's go back to PLab. The ETF of the cannabis is moving weird. Interesting. EBIT margins for this year is expected to be 30%, 31%, and the year after that. Okay, so yeah, let's pump up those short-term EBIT margins. We'll just kind of keep them both at 30% because I'm just going to keep them in 5s. You know, unless I have some specific reasons to be more precise, I like to keep things relatively simplistic. You know, it's like try to be humble, I guess, in your ability to be precise when it comes to valuations is kind of my preferred attitude. It's one of the reasons I like using distributions. It's because, you know, it's like be humble about the level of precision you can actually achieve when it comes to making valuations. You're not likely to be that precise. The goal is to be directionally correct, right? Not actually precise. So anyway, I'm just kind of throwing some numbers in here. Raindrops. Hey, how's it going? I think I've seen your name before a few times, right? Maybe not for a while. I feel like I've seen your name before. So then we got the average margins for the first 5 years down to 24%, which is still kind of high relative to that average. But again, those it seems like the analysts are expecting some higher levels. Maybe we can step ladder it down a little bit quicker. And we can even drop the mid level down a little bit further too, so it has to kind of climb back up to that average a little bit. That could help too. I want to get the average margins here a little bit lower. It's fine if the analysts think they're going to be very profitable in the short run, but let's not be too overly bullish on that. So we got 22% for the first 5 years on average before weightings. Within weightings, it becomes 22.5%. See, then we got like 15% for thereafter. Okay, so I'm okay with that. We're sort of assuming some relatively strong profitability levels for them, but okay, we're still just kind of trying to come up with some basic level stuff here. We were saying maybe about 2% for kind of terminal levels of reinvestment. Let's see what the expectations for the analysts are for, oh, that's right. This one doesn't have free cash flow estimates for the short run, which is kind of a little weird, a little strange, but whatever. We'll kind of run with it. We'll assume relatively high levels of reinvestment in the short run. And then in the midterm, we'll assume that it's on a little bit of a lower level. That's what we'll do. Yeah, so we'll assume higher levels of reinvestment up front, then down to relatively low levels, then up to our kind of average terminal levels. That's what we're gonna do. And I don't know, let's use maybe 5%. Because then on average, we'll still kind of be around a 2% over the course of the whole decade, which, you know, just kind of spitballing some numbers here. There's nothing, there's no secret sauce to this. There's no real serious magic. It's kind of just taking a guess until you go and build a model and go and look at the industry and go and really try to put together some more detailed elements of it. Really just kind of looking at longer term averages and seeing, it's like, does this even appear to have even a reasonable resemblance to value? You know, something like that. Raindrops. Yeah, probably a few months ago since I last visited your channel. Had a lot of stuff going on. Yeah, of course, you know, no worries. Happy I even kind of recognize the name. There's a lot of names, you know, you get in the chat. So some people are recognized more than others. And then my biggest curse is also the fact that different people have different names on different platforms. So I'm also get confused by that. So, okay, it looks like we got our average over the course of the 10-year period up to like 1.6%. And then it comes down to 2 in the terminal. I think I'm pretty comfortable with that. Come over to this page here. And what do we end up with? Well, it looks like we're a bit overvalued. Not, like I said, not super precise on any of these estimates here. You could argue about doing stuff with that. I think I'm being generous in the terminal multiple. I think I'm being generous in the margins. I'm probably not being super generous in the growth, but how much that helps you depends on the other things in the first place. So that's kind of a back and forth thing. And I'm probably not being super generous on the capital expenditures. I don't know. Maybe let's assume what happens if we maybe lower the capital expenditures. Maybe they're a lot more capital efficient than we're assuming. Does that improve things dramatically for them? I'm going to assume probably not too much. Give that a second to think. Then I do also kind of want to come over here too. Let's see. That's one of the factors I need to take account for, which is when you do an enterprise value valuation, which is the style of valuation we're doing here, then you need to account for other long-term investments that are not being carried at market value, and you also need to account for all other shareholders, such as minority interests that are being carried at book value as well and need to be adjusted upward. Usually the minority interest is one that definitely has to be adjusted. The long-term investments, more often than not, you don't need to do any adjustments there, but sometimes you need to do adjustments there. So anyway, the point is I mentioned that because they do have some minority interest here, and the price to book ratio on average for semiconductors is 5.2. Now I usually only go about halfway between the distance of there in the short term to adjust for kind of like a present value of that factor. But either way, I have the ratio currently at 2. So 5.2, half of that would actually be 2.6. So let's pull this up to 2.6, which means that we need to subtract a little bit more from the book value to account for that minority interest. Essentially is what we're doing there. So come back over to the page. It improved it by a couple percentage points, those last few adjustments we made with the capital expenditures, but not too much, it looks like. But yeah, so I don't know, it looks to me like Photronic is perhaps maybe 20% overvalued or something. 8.5% expected returns. Like I said, this is super basic work. We did this in what, half an hour, like I said. This was relatively quick work. There's nothing super special about the estimates that I put in here. If I went and studied the industry a little bit, studied the filings, learned about the volumes that they produce and some of the customers that they operate with or whatever, and build a full model for them, I could totally come up with some different stuff that could be either better or even worse, possibly. So don't necessarily, take this home to the bank. If you're a Photronic shareholder, don't run out and sell your shares just because I said this, is basically all I'm saying. But yeah, I mean, either way, not terrible returns either. If you were already holding, like I said, 8.5% expected returns, or whoa, actually it popped back down. I think it hadn't adjusted for that minority interest yet still. So it actually just dropped down to 30%. Oh, well, it got worse. It got a little worse. But 7% is not nothing. It's still not nothing. So there you go. I mean, that's a quick overview of kind of my process. As I said, that's kind of all I wanted to do here. Show you guys kind of like, this is what I do. This is, like I said, a very basic evaluation. So this isn't like how much work goes into a video. There's usually a lot more work that goes into making sure all of the guesses in here actually mean something in a video. But this is how we at least take a quick look to see if maybe there's something worth making a video for in the first place. This is kind of like, some of our earlier steps is like, we like to go look at an industry, we do a pricing analysis, we find what's cheap, and then we go and see if there's some basic value in the first place. And this is kind of what I mean by that. So pretty good process there. Unfortunately, Photronic was not a very pretty one to look at. It would have been kind of surprising if we had just grabbed one out of the blue that was a good value, to be honest, especially since I'm pretty conservative in some of the estimates I put in things here, right? So is what it is. So any other companies you guys want to maybe take a look at? We can maybe take a look at a few more companies on ticker, just some quick analysis, not another DCF. But that was kind of all I was planning to do today. I will call out again if you guys are watching live on the replay to maybe give us a like if you haven't already, subscribe to the channel if you haven't already, hit the notification bell, all of that. Join our free Discord. The link is in the description below. It's also the pinned comment in the chat. I don't think I mentioned that at the start, but the Discord is a great place to join, become part of our community where we have daily discussions of what's going on in the markets, what's going on in our own portfolios, the analysis of other companies and stuff like that. So come be part of the discussions there. Also, as I had mentioned kind of at the start of the stream, if you guys are very interested in my dashboard that I've been putting together and you think this is a really cool product and you would like to maybe have the ability to look up the financials as I've organized them in kind of the similar process that I just showed you here, as well as to look up the summaries of the DCFs right here, I'm making my dashboard available to people who are willing to pay $5 a month for it. I haven't set up a real payment system exactly for that yet, but I do have a PayPal and I'm willing to start a Patreon as well if people are interested in perhaps like I said, buying that service. So $5 a month and you can get access to a valuation dashboard that has a summary of all of my research. So yeah, I don't know, comment it in the comments or hit me up on Discord if you guys are interested in that. Just kind of wanted to throw that out there. So Raindrops, you want me to take a look at Hershey's? We can take a look at Hershey's. I actually already did a basic DCF of Hershey's. So this is going to be another situation where I say, hey, don't necessarily run out and make actions based off of what you see here, because it's just a relatively basic basic summary of some estimates here, but there definitely has been some people calling out Hershey's as potentially having some value. So I went and I wanted to take a look. I was like, okay, let's maybe take a look at this and see if there's an opportunity here. So I'll take a quick little look at what I came up with at Hershey's. We can do better than Ticker with this one, since I already have basic DCF for this one, but I will come over to Ticker to pull some estimates up. So you can see in the short run, we're expecting a relatively modest single digit growth, 3.5% for the next couple of years. They're expecting to have 23.5% EBIT margins for the next couple of years, and free cash flow margins 16-17% in that kind of range. So, you know, pretty good in that regard. Was it in another live stream or video? No. I haven't covered it in a video. I just have worked on it a little bit behind the scenes. I'm more than willing to cover it if you want to. I'm just saying, I'm just kind of spoiler saying I didn't find it to be a very good value at the end of the day. It's cheap relative to its history. That's the thing that I think a lot of people are looking at it with, is like, if you're looking at it relative to its historic multiples, it's definitely pretty cheap. Like, you know, it's definitely lower than its averages over the last decade. But the point is I don't think it's very cheap on an absolute valuation basis. If you're trying to make an absolute amount of annualized returns, I don't necessarily think that you can rely on that. It basically is only a valuation if it reinflates to these multiples. That's basically the problem with it, in my opinion. Because yeah, I mean, like I said, it's on average is traded 17 or 23 multiple, depending if we're talking about EV to EBIT or a PE ratio. It's currently trading at 16 and 19.5 respectively for each of those. The point is, like, EV to EBIT multiples, I usually, for this type of company, you're usually going to see it more like the aughts or the low teens kind of range. Like, this is a process manufacturer. The reason why it has those higher multiples historically is because Hershey's is a strong mode-ish of a company that a lot of people generally see of as having a strong brand. But when I make valuations, I don't generally give them that much of a wide berth based off of their brand. That's kind of all I'm saying. So, like, for example, the same process where I do right here, where I adjust the multiples downward based off the interest rates, I'm doing the same thing with Hershey's, and I end up with 16.5 for that. Now, I did actually go and find some comparables for Hershey's, and I added them in, and it didn't really change things. It kind of kept it still in this like 16 range. If I wanted to give them more of a little bit of a wide berth to the branding, I could use a terminal multiple around a 19 perhaps, and that would maybe change things a little bit. So, like, for example, coming over here, that's basically the problem with all very high quality companies. Yeah, basically, that is basically the problem. It's like, the only way you're going to see them as cheap is if you consider them, if you're adding that high quality factor into the value itself. But then you have to ask yourself, it's like, well, what happens if that quality starts to disappear over time? What happens to your returns? So, like, yeah, I try never to pay up for quality. I try to buy quality if for some fluke of a reason you can get it on a discount. The only way you get quality on a discount is drama, usually, or like, you know, some other major risk that makes people question the quality in the short run. That's usually the situation. So, like, for this valuation, I'm using a 17.5 terminal multiple, which is higher than the discount rate adjusted one, but a little bit lower than leaving the discount rate adjusted one in, and I end up with 25% overvalued. So, like I said, I could kind of give them a little bit of that multiple back to kind of like show you what it would look like under those circumstances. Like, let's maybe pop this up. Pop the terminal growth up a little bit. And you might be wondering, like, okay, well, what assumptions goes into that? We've got about 4% of revenue CAGR for the next 10 years. We've got operating margins on average for the next 5 years of 23%. And then the next 5 years after that of about 19%. Now you might say, like, well, why are the margins coming down so much? That's another question that one person might be able to ask. And, like, in general, I try to be a little bit more conservative on the terminal edge of the margins. And I would say, like, if we look at their margins over the last decade, the margins for the last decade have been 21%. But for the first 5 years, it was 19.5%. And then for the next 5 years, it was 22.5%. 8.5%. So by having them come back down towards 19%, I'm essentially moving them back down towards that like first 5-year period. I'm essentially saying that like for the last 5 years and the next 5 years, they've been in a kind of a higher profitability period, but I assume that they'll move towards a little bit of a lower profitability period in the future. Now, again, it's like one of these things where it's like, that might be extra conservative. And I might be being too conservative, and that might be one way in which that I'm going to end up passing up Hershey's as a valuation. But like, I tried to make sure all my valuations are taking into account some of the worst case scenarios. I try to include best case scenarios in there as well a little bit, but I tend to lean a little bit more towards the conservative side of things. Then the reinvestment levels, for, let's see, I have net negative reinvestment of about 0.5% per year. And then compared to, let's see, for the last, that's basically the same thing they did for the last decade if you adjust for acquisitions as well. So I'm basically assuming that they're gonna have the same capital efficiency for the next 10 years that they have for the last decade as well. So yeah, I mean, and then, okay, so like I said, I just adjusted the terminal multiple. If we take the terminal multiple from the what did I say? What was it before? Was it 17, right? It was like 17 and change. If we bring the terminal multiple up to a 21 from a 17, then they're only 10% overvalued. So we go from what was it before? It was like 30% or 25% or something like that to 10%. And even then, that's still with a terminal multiple of 21. So the question is like, at what multiple do you think you're going to be able to sell Hershey's? If that's part of your way of thinking, because I mean, obviously, you know, the idea, there's a relationship between discount rates and growth rates and multiples, and that's why I can show you how I enter discount rates here and growth rates here, and then terminal multiples come out here. But technically speaking, it's like, you know, they're kind of like two different relationships with two different things. One says I own the thing forever and then I earn this rate forever. The other thing says at some point distant in the future, I sell the thing for this ratio. You know, but there is kind of a causal relationship between the two. There is an identity there nonetheless. But yeah, so Hershey's, yeah, very, very high quality company, but I definitely think it's still a little bit on the pricey side. That's just my quick take. Like I said, that's based off of the fact that I don't want to rely on having a high terminal multiple in order to get my returns. That doesn't mean that you're not going to get it though, because yeah, it wouldn't surprise me if you would be able to sell Hershey's for a 25 multiple within the next few years. Like, that wouldn't shock me at all. It's just that I'm not going to buy it under that assumption. You know, that's basically the crux of the issue. Ariane, yo, what's up, man? Ariane asks, how can I make a time-weighted spreadsheet like you did, comparing yourself with the S&P 500? Well, that's a little bit tricky to go into. That definitely took a little bit of some trial and error. A few different versions as well, honestly, of putting my transaction spreadsheets together, because that's the thing. It's like I have I don't show those spreadsheets very much because that involves like showing all of my actual like transactions and my actual dollar stuff like that. I would definitely make it might be hard to make a video on it, but I would definitely like to. Like, it would be cool because I know, like, you know, like these types of spreadsheets are cool, and a lot of people think that these spreadsheets are cool, but my transaction spreadsheets are pretty cool too, because I mean, they're pretty useful. And I don't think a lot of people have very well put together spreadsheets for managing their portfolio as well as analyzing stocks, right? It's like they're almost like two different things. So it's like I wish I could show you. I don't know. Maybe I will try to put some stuff together, and I can maybe do like a special live show on it at some point. Yeah, I can maybe try to put some special stuff together on that at some point. No, I don't use any code. I don't really know any code. I'm pretty much like a codeless nobody when it comes to those skills. I have like none of those skills whatsoever. It's pretty much all just me using some spreadsheets and then you know, ninjaing them up a bit and being an engineer out of them. But I really ought to learn some code, to be honest. But yeah, no, yeah, I don't use any code on it. I kind of wish I did, because like literally I like every day when I buy stuff in the market, I literally go to my transaction spreadsheet and then I have to put those transactions in manually. So it's a little bit of some upkeep. If I definitely had some more knowledge on some other skill sets, I could be able to do stuff like that. But so, how often do you update the value of the portfolio? Every day. every day. I update that stuff every day. There's some parts of that I can show you. Like there's in my, because like on this spreadsheet right here, where this is where I have my portfolio all in one place. But then I have separate spreadsheets where all the transactions are, and then they're kind of all related to each other as well. But there is one page on here, this one right here, the data tab. There's a tab where it collects all the data, and I manually go through, and basically at the end of every market day, I manually go through and copy paste the line for the new day. It's literally just one line to copy paste, so it's not hard. It's literally just like, you know, one little keystroke to copy paste it. But I don't even have that automated, because like there's some weird kind of kinks to it that make it so that like all the ways I know about how to automate functions in Sheets, like they don't really work for this specific type of thing. It's a little bit obnoxious. But yeah, so like I don't know, I go to a decent amount of effort in terms of like how much things that I do manually to kind of track my portfolio. But like when you come over here, it's like I show you guys my like, you know, the year to date got reset here, but if you know, when you guys were looking at the live show a couple weeks ago at the end of the year, right, it had the whole year for the year to date, and almost every day of that was an actual data point. Like it showed what my actual portfolio value was on each of those days, and it has it benchmarked against the S&P. And then I have that going back all the way from when I started my investment portfolio near the end of 2018. So there's definitely ways you can use code to automate it. I just don't know how to do it. So that's all I'm saying. It's like there's limits to what I know. And I don't know. I keep never quite getting around to looking into certain things that I know would make my life easier, because I'm always so busy trying to like do other things that I end up like not doing plenty of other things that would make my life easier. Honestly, I wish I could just outsource more of those things to like other people. So that's just kind of part of the difficulty there. But yeah, on the transaction thing though, I will maybe try to put together a thing on how to show people how to maybe benchmark their returns. I can maybe try to do that at some point, but a little tricky. All right. But yeah, I think that is pretty much going to be it for today though, guys. I really appreciate you guys coming and chatting. It was really, really fun. Too bad, like I said, that Photronics didn't end up looking like a great value for us, and sorry for having to kind of rain on the Hershey's parade a little bit too, like I said, but it is what it is. If you guys haven't seen my Silver Corp video, go check out that Silver Corp video. I'm definitely very happy with it. I know it's not really the type of opportunity that's going to be as attractive for lots of other people out there. Lots of other people are not very interested in natural resource companies, mining companies, stuff like that. So I know it's not for everybody, but I definitely think it's a very interesting opportunity to it. And I'm very, very excited about the Heidrick and Struggles opportunity. I'm definitely planning on making a video for that one. It might be the next video that comes out, but I'm also maybe going to make a video for Premiere too, maybe. So who knows? Maybe it could be either one of those that comes out at some point in the near future. Definitely trying to get videos out a little bit quicker. I know it took a little bit of a holiday break there, so to speak, but you know, all of the pricing analysis we did, we were definitely trying to do it for something. Definitely trying to look for some opportunities and get them out there to you guys. So hopefully they turn into something good for all of our portfolios. But yeah, how about InMode? Well, what about it? I mean, it's still up there. I'm still buying it. So cheap. Yeah, I'm not buying it as fast because it's definitely, you know, it's starting to get sized. It's currently 3.8% of our portfolio, which it's at least up to the minimal size that we'd like to get it up to. But we're definitely not trying to buy it too quickly, because just in case it decides to languish for a while or even take some more dips. But I definitely feel like, you know, once the earnings start to come out, it's like maybe it won't be this quarter that will be a big turnaround for them. But at some point, there's going to be an earnings season, I think, for InMode that's going to really start to move the narrative back the other way. So maybe it's this earnings season, but I don't know, maybe not this earnings season. You know, I'm not necessarily super bullish on this earnings season per se, but it could end up being an interesting one still. Ditch the VOO and buy InMode. The VOO is part of its own separate strategy. Like, this isn't just a passive holding of VOO. I've covered this in some of my other live shows, but I do engage in a momentum trading strategy that's on a relatively short-term trading strategy where I'm attempting to essentially try to gauge changes in the momentum in the market. So to try to take a guess of when to short it based off of certain momentum indicators. And then whenever the indicators are not saying to short, I do go long. So this is essentially just me holding a long position, waiting for certain indicators to tell me to go and short the market on certain key specific days. So this isn't just a passive investment per se. It's kind of its own separate thing. But what it is essentially, it's basically just me making sure that I don't have too much cash in my portfolio. So I essentially just take whatever's left of my portfolio and I allocate it to that strategy whenever I don't have enough individual investments to make up the portfolio. But I try not to make my individual positions too large because I try to make them not have too large of an impact on my portfolio if there's a downside reaction. I try to have the upside be disproportionate enough that it scales it regardless of that fact. But we try to manage our downside risk by not over allocating to any one specific position. So I'm not trying to go too balls to the walls with InMode, despite me thinking it is a really good opportunity. Raindrops, have I ever done an evaluation of Williams Sonoma? I have. I have some old live streams on that one, or actually, I'm not sure if they're still on the channel. They might be some of the ones I cleared off the channel. But back in my old style, where I used to do the DCF live pretty much every time, I did do Williams Sonoma, and I have done some basic valuations of them somewhat recently, and I didn't find them to be too great of a value either. But it's a really great company. I will say I do like Williams Sonoma as a company. I think they're a very, very well situated retailer that has put a pretty good digital footprint for themselves in general. But yeah, since they've rallied so much, yeah, it's like they're definitely not super cheap right now. Oh, and then yeah, they definitely had their really, really nice day way back when, right? A month or two ago or something. I remember a member of our my cat sneezing. I don't know how much that came over the mic, but my cat just woke up and started sneezing like crazy. But anyway, our viewer Jeff, who often shows up, he's not here in the chat today, but he's in the Discord and in the channel from time to time, was definitely a major pusher of Williams Sonoma, and we were congratulating him on the day that happened. So yeah, I don't think they're cheap. But they're a good company. They're a very, very good company regardless. It's all right. That's it for today, though. I'll catch you guys in another live stream next week. And then, like I said, we will perhaps have to get to that Hydreight and Struggles video at some point in the near future. All right. Catch you all next time. Bye.